Housing Market Doomsday, 100x worst in 2008. The data they're hiding. The global housing market is on the brink of an unprecedented crisis, one that could dwarf the infamous 2008 financial crash. While mainstream media outlets provide a watered-down version of events, beneath the surface lies a wealth of data that suggests a catastrophic collapse is looming. From skyrocketing mortgage rates and record-breaking home prices to declining affordability and mounting corporate greed, this YouTube video uncovers the suppressed truths about the housing market's impending doomsday. The warning signs are flashing red. The 2008 housing crisis was triggered by reckless lending practices, subprime mortgage, and a grossly over-leveraged financial system. Today, the signs of a collapse are even more pronounced, but this time, the crash may be exponentially worse. Here's why. 1. Unprecedented home price inflation. Over the last decade, housing prices have soared at an alarming rate. According to the Case-Shiller Index, home prices have increased by over 60% since 2012, far outpacing wage growth. The affordability crisis is reaching a breaking point, as middle-class families are now being priced out of homeownership in major cities. The median home price has risen to unaffordable levels, even for dual-income households. The year 2025 has ushered in an era of extreme home price inflation, exacerbating an already dire housing affordability crisis. With mortgage rates still high, institutional investors dominating the market, and supply chain issues persisting, home ownership is slipping further out of reach for millions of Americans. The real estate landscape is becoming increasingly unsustainable, raising concerns of an impending market correction or collapse. Home prices in 2025 have reached record-breaking levels, far surpassing wage growth. According to recent reports, the national median home price has surged by over 75% since 2015, with some metropolitan areas witnessing price hikes of over 100%. Cities like Los Angeles, Miami, and Austin have seen bidding wars drive prices to astronomical levels, making it nearly impossible for middle-class families to buy homes. Key factors driving inflation. 1. High interest rates. Despite slight fluctuations, mortgage rates remain elevated, increasing borrowing costs and reducing affordability. 2. Institutional investors. Large investment firms continue to acquire vast amounts of residential properties, limiting inventory for individual buyers. 3. Persistent supply chain issues. The cost of building materials and labor shortages have hindered new home construction, restricting supply. 4. Global economic instability. Inflationary pressures and economic uncertainty have driven more investors into real estate as a safe asset, further inflating prices. Mortgage rate shock. In the wake of record low interest rates post-2008, homebuyers were lulled into a false sense of security. However, as central banks scramble to combat inflation, mortgage rates have skyrocketed. In 2021, the average 30-year fixed mortgage rate hovered around 3%. As of 2024, rates have surged past 7%, with projections indicating further increases. This sudden hike is leaving many homeowners unable to refinance, trapping them in a financial vice grip. Homebuyers who were once accustomed to historically low interest rates are now facing an economic reality where borrowing costs have skyrocketed. This phenomenon, known as mortgage rate shock, is causing widespread affordability concerns, reshaping the real estate landscape and raising fears of a potential housing crisis. The rise of mortgage rates. Over the past few years, mortgage rates have seen an unprecedented surge. In 2021, the average 30-year fixed mortgage rate hovered around 3%, making homeownership relatively affordable. However, as central banks aggressively raise interest rates to combat inflation, mortgage rates have surged past 7% in 2025. This sharp increase has made monthly mortgage payments significantly more expensive, discouraging potential buyers and putting financial strain on existing homeowners. Impact on home buyers. The rapid increase in mortgage rates has severely diminished home affordability. A buyer who could once afford a $400,000 home with a 3% mortgage rate now faces a much higher monthly payment with a 7% rate, potentially pricing them out of the market. Many aspiring homeowners are either delaying their purchases or opting for smaller homes in less competitive markets. Additionally, many buyers who secured loans at historically low rates during the pandemic are now unable to move, as refinancing or purchasing a new home would result in dramatically higher interest costs. This has led to a sharp decline in housing market activity and transaction volumes. Impact on existing homeowners. For existing homeowners, mortgage rate shock has presented significant challenges. Those with adjustable rate mortgage, ARMs, are particularly vulnerable, as their interest rates have reset to much higher levels, resulting in unaffordable monthly payments. This has led to an increase in mortgage delinquencies and foreclosure risks. Furthermore, homeowners who had planned to sell their homes and upgrade are now holding back, unwilling to give up their lower mortgage rates. This has contributed to a tightening housing supply, further distorting the market dynamics. Broader economic consequences. The ripple effects of mortgage rate shock extend beyond individual homeowners. The broader economy is feeling the strain as housing-related industries such as construction, real estate, and home improvement are experiencing declining demand. Mortgage lenders are also facing financial pressure as loan origination volumes plummet. Additionally, declining home affordability has put downward pressure on home prices in certain markets. While some areas remain resilient due to supply shortages, others are seeing price corrections as demand weakens. Future outlook. As interest rates remain elevated, the housing market is likely to continue facing challenges. Potential policy interventions, such as rate cuts or government-backed affordability programs, could help stabilize the market. However, if inflation remains persistent, central banks may keep rates high, prolonging affordability issues and increasing the risk of a prolonged housing downturn. 3. Institutional investor domination. Unlike 2008, where individual homeowners bore the brunt of the crash, today's housing market is being manipulated by Wall Street investors. Companies like BlackRock, Vanguard, and private equity firms have been buying up vast swaths of single-family homes, artificially inflating prices. With ownership concentration in the hands of a few, average homebuyers are left competing against billion-dollar firms with virtually unlimited cash reserves. 4. Record-breaking household debt. The U.S. household debt has reached an all-time high, surpassing $17 trillion in 2024. A significant portion of this debt is tied to mortgage, and as interest rates climb, many homeowners are now struggling to make monthly payments. This debt bubble is eerily reminiscent of 2008, but on a much larger scale. 5. A rental market crisis. With homeownership becoming unattainable for many, rental markets have exploded. Rents in major cities have seen double-digit percentage increases year over year. Renters are now spending over 50% of their income on housing, far exceeding the recommended 30%. This situation is not sustainable, and as economic conditions worsen, a wave of evictions and homelessness looms. Skyrocketing rents, stagnant wages, and a supply-demand imbalance have created a situation where many renters are struggling to keep up with rising housing costs. As rental prices continue to outpace income growth, the crisis is intensifying, pushing more people into financial distress and even homelessness. Over the past few years, rents have surged at an alarming rate. In major metropolitan areas, rent increases have outpaced inflation, with some cities seeing double-digit percentage hikes year over year. Factors such as increasing demand, limited housing supply, and corporate ownership of rental properties have contributed to the rapid escalation of rental costs. The hidden data, what they don't want you to know. The mainstream narrative suggests that the housing market is merely experiencing a cooling off period. However, data from various independent sources tell a different story. Foreclosure filings are spiking. According to a TTOM Data Solutions, foreclosure activity in 2024 has increased by 150% compared to the previous year. Adjustable rate mortgage, ARM-A resets are pushing many homeowners into delinquency. This will only getting worse in 2025. Corporate defaults on real estate holdings. Major real estate investment firms are quietly offloading properties at a loss, signaling distress. Commercial real estate collapse. Office space vacancies are at all-time highs, and landlords are defaulting on loans, further straining the financial system. What comes next? The looming crash. The signs are clear. We are heading towards a housing market doomsday that could be 100 times worse than 2008. Here's what's likely to unfold. 1. Massive home price declines. As interest rates remain high and demand dries up, home prices could plummet by 30 to 50% in many markets. 2. Banking failures. Regional banks heavily exposed to real estate loans could collapse under the weight of bad debt. 3. Government bailouts and hyperinflation. If policymakers intervene to save banks and mortgage lenders, the result could be rampant inflation. 4. A surge in homelessness and social unrest. The inability of millions to afford housing could lead to increased social and political turmoil. Final thoughts. The housing market is not just in trouble, it is on the verge of a catastrophic collapse. The warning signs are clear, and the hidden data suggests that this crisis will be exponentially worse than 2008. The question is not if the market will crash, but when and how severe it will be. Now is the time to prepare, whether by reducing debt, securing assets, or rethinking homeownership plans before the inevitable storm hits.